Welcome to the deep dive. This is where we take your questions, the stuff you're really wondering about, and, well, we dive deep to pull out the insights you need fast.
Right.
Especially for you, the learner. We know you want that clarity, those aha moments, but without getting totally buried in information. So for this deep dive, we've pulled together your most frequent questions about personal finance, looking ahead to 2025.
Yeah, the things really on people's minds.
Exactly. Our mission really is just to offer some clarity, maybe some actionable ideas on money stuff, inflation, investing, debt, in the housing market. It's all in there. Think of it as your quick guide to getting financially oriented for next year.
Absolutely. And look, these are questions we're hearing a lot. It's about cutting through the noise, finding those solid principles to help you make good decisions for your financial future.
Okay, let's jump right in then. The first big one, and I think we're all feeling this, why does everything still feel so expensive?
Yeah, it's a persistent feeling, isn't it? And there's a pretty straightforward reason. We hear inflation is slowing down, which is true.
Right.
But, and this is key, slowing inflation doesn't mean prices are actually falling.
Okay.
Think of it like a bathtub filling with water. Slowing inflation is like turning the faucet down a bit. The water's still rising, just not as fast.
Yeah.
Or maybe it stopped rising, but the tub's still full,
That's a great analogy. The water level is still high.
Exactly. So those higher prices we've seen for groceries, for rent, for gas, they kind of stick around. Your money just doesn't stretch as far as it used to.
Okay, that makes sense. It's not getting worse as quickly, but it's still high. All right, next question, and this one feels very personal. Is a $100 case still a lot of money?
Oh, that's always a fascinating one. And the answer is, it really, really depends. The biggest factors, location, and of course your lifestyle.
Right, $100 in New York City versus, say, a smaller town. Totally different ballgame.
Totally different. In those high cost of living places, New York, San Francisco, $100,000 can, it can feel like it disappears pretty fast, especially with rent. You could easily be looking at $3,000, $4,000 a month or more.
Yeah, we actually heard from someone who moved to LA from Italy, had a $100 case saved, felt pretty good about it,
Okay.
but then saw friends spending like $5,000 a month just on rent and going out. It was a bit of a shock.
Wow, yeah. That really paints a picture, doesn't it? So the bottom line is, its value really hinges on your circumstances. Where you live, what your goals are, what you consider a lot depends entirely on what you need it to do.
What you're aiming for.
Precisely. And that kind of leads naturally into the next big question people have when they think about those goals. Should I still be investing in the stock market?
And the answer, hopefully, is pretty clear.
Yes, a definite yes. For long-term wealth building, the stock market is still a really fundamental tool.
Okay.
History shows the average return hovers around 10% per year. Now, that's an average. Obviously, there are ups and downs.
Sure. Not guaranteed every year.
Not at all. But to make it concrete, if you invested $100,000, that 10% average suggests it could grow by about $10,000 in a year. Potentially.
And that growth really adds up over time, right? Especially if you're thinking long-term, like retirement. That $1 million target people often talk about.
Exactly right. That's where compounding does its magic. Yeah. If you get that average 10% return on your $100 K and you reinvest the gains after about 5 years, you could be looking at over $161,000. Wow. And another thing, when the market dips, those can actually be opportunities. Buying when prices are lower.
Buying low, yeah.
But, and this is crucial, you absolutely have to do your homework first. Understand what you're investing in. It's not gambling.
Right. Informed decision. So stock market.
Yeah.
Still a strong yes for the long haul, but do your research. Okay, now for something very current. Can I really trust AI, artificial intelligence, to manage my money?
That's a great question, and one we're hearing more and more. The best way to think about AI in finance right now is probably as a helpful tool, a powerful assistant, maybe?
An assistant, okay.
Yeah. You see platforms like Wealthfront, Betterment, they use algorithms, sophisticated programs, basically.
Right.
They analyze data, make decisions, build and adjust investment portfolios based on your risk tolerance, your goals. Some even give you tips or alert you to market shifts.
That sounds pretty useful. Take some of the emotion out of it, maybe, but can you just set it and forget it? Let the AI handle everything.
Not quite. Not entirely. Look, AI offers real advantages, automation, analysis, but it shouldn't replace your own understanding.
Okay.
You still need to know your goals, your comfort level with risk. That's fundamental. And you need to do your homework on the AI platform itself.
Yeah.
What's their track record? What data are they using?
Makes sense. Due diligence applies there too.
Absolutely. So think of AI as a valuable addition to your toolkit, a co-pilot perhaps. But you're still the pilot. You need to understand the flight plan.
Good analogy. Co-pilot, not autopilot.
Okay.
Now let's tackle a classic financial tug of war. Should I pay off debt or should I invest?
Ah, the balancing act.
Yeah.
The general rule of thumb, focus on high interest debt first, aggressively.
Like credit cards.
Exactly.
Yeah.
Credit cards often have rates, 20%, 25%, even 30% sometimes. That interest just eats away at your finances. It's almost impossible to earn investment returns that consistently beat that kind of interest rate.
Yeah, you're just digging a deeper hole trying to invest while carrying that.
Pretty much, it's like running on a treadmill backwards. However, when you talk about low interest debt, like a mortgage, maybe a low rate student loan,
Yeah.
the calculation changes a bit.
How so?
Well, if your mortgage rate is, say, 4%, and you expect your investments to return on average, maybe 7 or 8% over the long term,
Then mathematically, investing might make more sense.
it might. There's an argument for investing while you continue making those low interest payments. But you also need to consider having savings, an emergency fund. That safety net is crucial.
Right, liquidity matters.
It really does.
Yeah.
So ultimately, it's a personal choice. It depends on the specific interest rates, your risk tolerance, your overall financial picture. Often, finding a balance media aggressively paying down the bad debt while still putting something towards investing is a good approach.
A balanced strategy. Makes sense. Okay, switching gears a bit. Passive income. Everyone seems to want it. What's a good passive income idea right now?
Yeah, the appeal of earning money without, directly trading hours for dollars is huge. And there are some interesting avenues. One that's really popular, creating and selling digital products online.
Digital products. Like what?
Well, if you like writing, maybe an ebook. If you have expertise, an online course. Got design or tech skills, maybe Notion templates, website themes, stuff like that.
Things you create once and can sell over and over.
Exactly. The upfront work is in the creation, but then it can potentially generate income with less ongoing effort.
Okay, interesting. What else?
Another big one is affiliate marketing. Basically, you promote other companies' products or services.
Using special links.
Right. You get a unique link, share it maybe on a blog, social media, through email, and if someone buys through your link, you get a commission. It helps if you have a knack for marketing, for building an audience.
Sure, you need people to click the links.
Definitely. And something that's maybe a bit overlooked but can be powerful, newsletters.
Email newsletters.
Build a loyal audience around a specific topic you know well. Then you can monetize it, sell your own digital products, run affiliate links, maybe get sponsors. Good for people who enjoy writing and building a community.
Lots of options then. It seems like the key is matching it to your skills and interests.
That's exactly it. Find what fits you and what you're willing to put the initial effort into.
Got it. Okay, let's talk housing. Big topic. Is the housing market gonna crash? Everyone's wondering.
Understandably so. It's been, volatile, hasn't it? Remember 2020, 2021? Rock bottom interest rates, everyone wanted more space. Demand just shot up.
Oh yeah, bidding wars, prices going crazy.
Exactly. Then the Federal Reserve stepped in, started hiking interest rates to fight inflation. Mortgage rates basically doubled pretty quickly.
Which really squeezed buyers.
Absolutely. It cooled things down fast. Buyers pulled back. Sellers had to start reducing prices from those peaks.
So prices came down a bit, but it wasn't really a crash, was it?
No, not generally. And the main reason is supply, or rather the lack of supply. There just haven't been enough homes for sale to meet the demand, even the reduced demand.
So inventory is still tight.
In many areas, yes. Inventory shrank, and there's still competition among buyers, which keeps prices relatively high. Plus, you have demographic factors, younger generations trying to buy, people staying in their homes longer. It all contributes to less supply.
Okay, so the market's cooled off from the frenzy, but a crash doesn't seem likely right now because there just aren't enough houses.
Based on the current dynamics, a widespread crash doesn't seem like the most probable outcome, no. It's more of a correction or stabilization, perhaps.
That's helpful context. Now, for anyone listening who hasn't started investing yet, maybe feeling like they missed the boat, is it too late?
Absolutely not. Unequivocally, no. It is never, ever too late to start investing.
That's encouraging.
There's that great saying, right? The best time to plant a tree was 20 years ago.
Because the second best time is now.
Exactly. It applies perfectly to investing. Honestly, starting small, being consistent, that's way more important than trying to wait for the perfect time, which might never come. And nowadays there are apps, platforms, They make it so easy to get started, even automate it.
So just start, even small. Okay, love that. All right, thinking about 2025 specifically, budgeting. What should we really be focusing on in our budgets?
Budgeting is always foundational, isn't it? For stability, looking ahead, a few key areas stand out. Number one, always the emergency fund.
Right, the safety net.
Gotta have it. Aim for, ideally, 3 to 6 months of essential living expenses saved up. For those curveballs, life throws, job loss, medical bills, whatever, it buys you breathing room.
Crucial. What else?
If you rent, keep a close eye on that cost. Budget for potential increases. Maybe think about negotiating your lease when it's up, or, if feasible, roommates. Just be proactive.
Good point. Housing costs are a big chunk for most people.
For sure. Also, think about potential job changes. The market's dynamic. Might you switch careers? Need new skills? It's wise to plan for potential income dips or costs associated with retraining.
Being prepared for transitions.
Exactly. And finally, something often overlooked in budgets, mental health.
Oh, interesting. How does that fit in?
Well, budgeting for things that support your well-being, therapy, hobbies, exercise, even just downtime, it's important. Having a budget that allows for that flexibility actually reduces stress. It gives you peace of mind.
That's a really holistic view. Budgeting for well-being, not just expenses. I like that. Okay, last big question, the broad view. Should I be worried about the economy?
Look, constant worry isn't productive, but being aware, that's essential.
Aware, not anxious.
Exactly. There are big shifts happening globally, no doubt. In trade, in technology, and the kinds of jobs available, things are changing.
So how do we navigate that?
The most empowering thing you can do is stay informed. Keep learning. Be adaptable. Those who make an effort to understand the trends, who are willing to develop new skills, to pivot, they'll be much better positioned to navigate whatever economic changes come our way. It's about agency, not anxiety.
Awareness, adaptability, action. Got it. Well, that covers a lot of ground. These were real questions from real people like you listening. We hope this deep dive gave you some valuable clarity, maybe some actionable takeaways for your finances heading into 2025.
Yeah, hopefully some useful perspectives.
So take a moment maybe. Think about which of these topics really hit home for you. And here's a final thought to leave you with. Considering all these different facets of personal finance for 2025's inflation, investing debt, housing, budgeting, what's one specific, concrete action you feel most empowered to take right now to improve your own financial well-being? Something to think about.